This is the Daily Market Rundown live from the Tradelo trading floor. It's June the 6th, some highlights from today's show. Trump and Xi hold a phone call, Trump and Musk go head to head, and the non-farm payrolls is now in play. Good day traders, and welcome and a happy Friday to all of you joining us live. There's a number of things of course to pay attention to today, so let's get stuck straight into it. Starting of course with our first headline topic, which is all about Trump and Xi Jinping holding the phone call. Now earlier this week I put out a tweet saying that look, it's very unlikely they're going to hold a phone call in the near term, and the logic behind that was if you understand ultimately how ultimately the Chinese do deals, they very seldom do it right at the top. Okay, it's very much a case of the Xi Jinping effectively relies on his minions, for lack of a better word, to ultimately go out and do the deals, to ultimately go out and get the certain terms that the Chinese are willing to ultimately settle on, and so that's where this idea was born, that what's likely to happen is Xi Jinping will hold off on making a phone call. He'll just simply let the subordinates below him do all the deal making, and when there's actually finally something to talk about, when there's something to actually sign off on, fine, then he'll get involved, then he'll hold a phone call, almost like then he'll get involved in cutting the ribbon. Okay, it's like the cutting the ribbon moment, and that's typically how the Chinese do deals, whereas President Trump prefers to kind of do deals right at the top. He prefers to get his hands dirty and get some terms agreed. Now if we look at ultimately the two different ways in which the media reported, the US side of the phone call as well as the Chinese side of the phone call, I suspect we got exactly that. We got more of a respectful call from the Chinese, in the sense of they held the call simply to just show face, as opposed to actually any kind of anything of importance coming out of it. And I think that's the key thing to take away, because the way it was phrased from the US side was it's a very positive call. We're in very good shape with China and a trade deal. It was sort of this, we had a fantastic call, everything is going according to plan, we're going to do deals. That's kind of the typical US side of things. Whereas if you actually go and have a read at how the Chinese transcript looked, it was very much exactly what they've said for the last couple of weeks and months, which is the US has to show respect, the US has to remove these sort of tariffs that they put in place, and until they do that, we're not willing to kind of move anywhere. And so it was this almost repeat of show respect, and then maybe we can ultimately start to work towards a big picture plan of what trade could look like. So again, I don't think it was anything to take away from it. There was absolutely nothing positive from it. And we are nowhere nearer resolving ultimately the spat between China and the US. And so yes, whilst we do have a sort of a 90-day delay in place for China, I don't expect anything's going to come anytime soon between the Chinese and the US. Okay, now let's get into our second topic, of course, for today, before we move on to some interesting charts. It was very much about, of course, the spat going on between the likes of Donald Trump and Elon Musk. And I think the key takeaway from it, I know the market did have a little bit of an offer on Tesla. In essence, Tesla was down 15% on the day. The reality is that no, this sort of spat between Musk and Trump has no real implications for global markets. Sure, I get the logic behind why you'd want to sell Tesla on that. Makes absolute sense. But I think the reality is that overnight, calmer heads have prevailed. I think what everyone's realized is that the last thing we want or need is for the world's richest person and the President of the United States to go onto social media land and kind of divulge, and speak the way they were speaking. Okay, that does not do anyone any favors, and they have both got significant leverage over each other. So I think that's ultimately what there was a little bit of nervousness about. But like I said, cooler heads have prevailed. I suspect there'll be a phone call held. They'll agree to disagree, but I don't think it goes away. Okay, I think that's the key takeaway. I think what we are going to see now as a result of this, we are going to start to see some of the Republicans within the Senate pushing for changes to the big, beautiful bill. And again, it all just depends on ultimately how the bonds perceive that. Okay, now don't forget, we've got until July the 4th, so we've got 1 month in essence now where the Senate is going to be debating the bill. And we have to watch that. We have to watch very, very closely for certain things. Section 899 is one that's going to be closely watched, as well as, of course, some of the permanent tax cuts that want to be pushed through. So Again, right now, perhaps we're not going to get anything, but we do need to keep a close eye on that spat. And of course, if those tempers do flare up again, we do obviously want to be aware of it. But very much nothing too much to take away from that. What was interesting yesterday is on a day where perhaps ultimately we had bonds offered. Okay, we had long bonds were selling off in the afternoon. We had a scenario, of course, where equities were kind of choppy all over the show. Corporate bonds again staged another really good bit up. Okay, this is the corporate bond yields, and you can see there again, they just keep getting squashed. We're now sitting around that 721. It's sort of that almost back towards those March levels. And again, it just points to a scenario where corporate America is really, really not struggling with higher interest rates, not struggling with ultimately the tariff concerns. There's just no real struggle in corporate America right now. And credit spreads are continuing to narrow. Okay, I think that's the key takeaway, and we have to be aware of that, because as much as we see a lot in Twitter land that the world's coming to an end and things are going to slow and the US is going to fall off a cliff, credit spreads are reflecting the opposite. Okay, credit spreads, if anything, perhaps could start to showcase a bit more of a re-acceleration. Okay, don't forget, if this big beautiful bill does go through, 67% deficit spending is fantastic for corporate America. Okay, and it will squash those credit spreads, and ultimately all that means is we're going to see higher revisions for earnings in the US, and that just means stock markets back to record highs in the near term. Okay, now that matters because contextually, as we go into this non-farms today, I suspect it's one of the final key risk events to pay attention to before we actually do run up towards those record highs. I think if we clear the bar today, if we have an okay number, I think 6,000 on the S&P is not going to last very long. And ultimately, whatever inflation does next week, I don't know that that's going to have too much of a bearing. So this could well be the final risk event before the S&P, the Nasdaq, do start to make their way back up towards those record highs. Now, with that in mind, let's get into it. Let's talk NFP because that's the purpose of today's stream. And it is the key risk event for this week, for this month, and perhaps for some time. I think this is a very important print simply because it is the first sort of real hard data point that matters for the Fed and, of course, the U.S. economy since the Liberation Day tariffs. Okay, so we've had a full month in essence of uncertainty in the market, and the question is now: have companies been laying off or not? Have they looked beyond the uncertainty and just said, "Look, we'll suck it up until we get more information," or did they lay off employees? That's what everyone wants to know. And whatever we get today is going to set the tone moving forward. In other words, if the number comes out better than expected today, the reality is the market now not only has to accept that the Liberation Day tariffs had zero impact on the labor market, okay, but if anything, a lot of companies have been hoarding employees, and as a result of the spending that's coming down the pipeline, we could start to even see an acceleration. Okay, and I think that's a theme that a lot of people are thinking about, which is if the worst case scenario didn't even lead to a softening in eco data, that does suggest we are still sitting with a very solid economy that's about to have rocket fuel added to it with the likes of all the deficit spending. Okay, now a few things to note. At the headline print, we're expecting 125 as per Bloomberg. If we look at the range of forecasts, it's between 75,000 and 90,000. We'll talk a little bit about that range in a minute. The high-end forecast on Bloomberg is 190. The low-end forecast 75. Now, I'll get to scenarios in a minute, but a few things to pay attention to. We know that the 6-month average is around 193, which is right at the top end of that forecast, and we know that the Powell sort of baseline number is 100,000. Okay, Powell has told us quite explicitly that they need to have 100,000 jobs per month ultimately to keep that unemployment rate from rushing higher. Okay, so it's almost like, so long as it's above 100,000, it's okay. And of course, if it's above that 190,000, it's starting to point towards a little bit of re-acceleration in the labor market. Okay, now with that in mind, we'll get on to the unemployment data in a moment, but let's talk about some scenarios because we've got a few. Obviously, every bank puts out their scenarios. This is Goldman Sachs' scenarios. But the way I want to do it is I'm not going to go through Goldman Sachs' scenarios. You can do that in your own time. I want to frame it for you as to how I understand it and interpret it. Okay. And the best place to start is a number of greater than 100,000. Okay, if we get a number of 100,000 to 125,000, okay, the reality is that yes, the markets will initially look at that as a little bit on the soft side. Okay, but like I said, so long as it's 100,000, that's fine. We're probably expecting, there's probably some expectation given, and we'll get onto the VIX chart in a minute, there's probably some expectations that it could miss to the downside. Okay, in other words, the market's kind of hedged for a slightly softer print. Okay, so if it comes in 100 to 125, it's priced, it's expected. Moreover, don't forget, and this is key, the Fed is very alert to ultimately a softening in the labor market. Okay, and then this is important to stress, because when I get to sort of what happens if we go below 100,000, it's important to understand that the Fed is still sitting with restrictive policy. They are very much aware of the fact that they can cut quite a lot to get to neutral still, and the only thing stopping them from going and cutting right now is this idea that they are going to have a little bit more inflation later on this year. But, and this is the caveat, they have told us that if there is a sudden slowdown, they believe the net effect in a slowdown in jobs will also be a net effect slowdown for inflation. Okay, so they will not hesitate to cut at the June-July meeting if there's a very bad print today. It's important to stress that they will move very aggressively if the data warrants it. Okay, despite the fact that inflation is running hot, they will cut interest rates. They will not hold off should we see a very, very bad number. We'll get to that scenario in a minute. Okay, so the point is, a number above 100,000 to 125 is okay. It's not a bad number. It's okay. It's enough. It's good enough. Above 125, that's good. That's looking really good at a time when ultimately the markets perhaps were concerned about the uncertainty because of the Liberation Day tariff. So 125 or above, say 125 to 175 will be taken very positively from the market. Okay, above 175, like I said, we're above that 6-month or very close to that 6-month average. We're also in line with ultimately last month's print, and that really does put to bed this idea that the Liberation Day tariffs were bad for the US economy. Okay, so that will be taken very, very positively by the market. We will smash right above that 6,000 level in the S&P, and we will be at those record highs over the course of the month of June. Okay. And then, of course, the degree of beat above 175, I mean, if we have a 250 number, which of course is possible, you just got to imagine and dream about what can happen then. What I will say, if you look at that 60-50 strike as well as the 60-90 strikes, there's some seriously negative gamma sitting up there. So what we should get is a very, very nice short squeeze. Not necessarily a short squeeze, apologies, but a gamma squeeze above 60-50. Okay, in other words, the dealers are going to be very aggressively buying that market above 60-50 in the S&P, and we will get there, no doubt, with a print of 250 or above. Okay. Let's talk about the other side of the scenario, because there's obviously the potential for weak prints. So like I said, I think anything above 100,000 is okay. It's good enough. Okay. Let's talk about the other side of the scenario. Let's see if we get let's say if we get a number of less than 100K. Okay, so less than 100,000, but still greater than 75. Okay, this is going to make the market a little bit nervous contextually, and we'll get to this chart in a minute. Don't forget, the S&P is sitting elevated. We have had quite a sustained rally for some time now. So I do expect if that number comes in somewhere between 75 and 100, we're probably going to finish the day down around 0.5% to 1%. And ultimately, the market will just be giving up some of the most recent gains. Okay, it's not a trend setter. It's not a OMG. Why? Because like I said, the Fed will be reactive. Okay, they are not going to hang around and wait. You'll also see, and this is important to stress, you will see Trump coming out saying, Powell, cut, you need to cut. Why are you so late on cutting? Okay, very, very important to stress. The Fed is not going to hang around and wait if we do get a print in and around that 75. Okay, it will open the door to a July cut, and we'll talk about those rate expectations in a moment. Okay, what happens if we go less than 75? Okay, I think this is where it starts to become interesting. I think anywhere between 0 and 75, that does open the door of concern. It does point towards a scenario where perhaps there was a little bit more weakening than what anyone thought. Okay, and I think that sort of a scenario is where the S&P is down greater than, I'm using the wrong signs here, but greater than 1% on the day. So anything less than 75,000, I do think we are going to have some problematic moves in the equity. So think equities down, bonds up, and of course dollar down the page. Okay, and then what happens if we go negative? Again, this is not something that's high probability. It is something that's very possible. It's something that ultimately the market will panic on. Okay, a negative number today, all bets are off. Okay, you can bet your bottom dollar a number of things happen from a negative number. First of all, the Fed will be cutting at the June meeting. It's as simple as that. They will not hang around. Not only will they be cutting, I suspect you get a negative print, they're probably going to cut 50. They're going to go pretty hard, pretty fast. And it's important you understand that, because if that is the scenario, if it's a negative print today, you've got to be long the front end of the curve. You have got to be very short of the dollar. And ultimately, that is where the key opportunity is going to come. Okay, now, sure, equities will also have a nosebleed day as a result of that because of where they are trading on the chart in absolute prices. Okay, but a negative print, very unlikely. But should we get that negative print, it's going to take that odds of a recession from around 25% all the way back up perhaps to 50%. Okay, so keep a close eye on that. That is one scenario that, as day traders, we should capitalize on. Okay, now let's get across and talk a little bit about the BLS. They have put out this note to say that there's going to be a slight revision, but it's not going to be meaningful. It should be somewhat negligible. So what that does mean is we're probably going to get a revision that is a little bit lower than what we had last month of the 177. So of course, do keep an eye on that, because should the revision come out 100,000 or more, okay, that's going to kind of point to a couple of head scratches as well. Okay. Now let's talk unemployment, because this is something that ultimately can also create a surprise. There's a number of reasons for that. There's a general thinking and consensus that a lot of the undocumented immigrants that are in the US working illegally effectively could come back into the participation. So there's always this risk of a sudden spike where there's actually a lot more available unemployed people. But again, I think the key takeaway from this ultimately is that the Fed thinks unemployment will be around 4.4% by the end of this year. Okay, the expectation today is for 4.2. If we got that spike to 4.4, right, that is going to create, again, a head scratcher, sort of a scenario of, well, hang on a sec, are things actually a little bit worse than what we actually anticipated? So keep an eye on that. I think a small uptick to 4.3, not necessarily problematic because the Fed median dot is for 4.4 this year. So just keep an eye on that. I think anything above 4.4, at 4.5, we start to question that SAM rule. That starts to come into view, not this month, but perhaps next month and beyond. So again, we'll just increase the odds of a potential recession. Now, let's talk about those rates, those implied rates, because what you can see there, this is the June meeting, 432 is the implied rate. Effectively, nobody is thinking about a rate cut in June. Nobody. This meeting is, 10 days away from the Fed, and nobody thinks there's a chance of a cut. You get a sub 75,000, those odds are going to change. Okay, I suspect those odds will move at least 15 basis points. So what that means is there should be at least a 50-50 chance of a rate cut at the June meeting. Okay, like I said, number comes out negative, that's probably going to be closer to a 100% chance of a June cut. It should be at least a 100% chance. And like I said, there will be some bets for a bigger than 25% basis point cut. Why? Well, don't forget, the Fed last year panicked, cut 50 the moment they saw signs of weakness in the labor market. Okay, so it's no different. Keep with that in mind. You can see even the July meeting, they're only pricing around 11 basis points. So call it a 1 in 3, maybe perhaps slightly better. 1 in 3 chance of a rate cut for July. The real cuts only come in September and December. We can see the market's pricing currently around 2 cuts for this year, okay, which is in line with the Fed dot projections. Okay, so the point is that structurally going into this meeting, it's very binary. I think if the number's above that, sort of 125,000, we are going to take that 6,000 level to the upside in the S&P. Whereas if the number comes in below 75,000, of course, that is going to point to some greater chance of a recession this year. Now, contextually, let's talk charts, because VIX is sitting elevated relative to the last 2 sessions closes. Okay, that is exactly what I said earlier this week. We were talking about be careful being long S&P above 6,000 because the market's going to hedge itself into NFP. It's exactly what it's done. It's hedged itself. That's what you saw yesterday in terms of the flows. There's a little bit of hedging. Why? Well, because people are going to be nervous into this print because it's a massive risk event. Right? There's always a risk of a bad number. But what it means is that those hedges are in play. Okay, everyone's hedged. If we did get a stinker number, fine. More people will need to hedge. But if the number comes in above or at 125 or greater, ultimately those hedges need to come out. Okay, and that's why I think even a number down to 100,000 is not problematic because it's hedged for that little bit of weakness. Okay, so you're going to need to see a really bad number to see that VIX prop up. But likewise, a number of 125 or greater, not only are we going to squash out that, we're probably going to squash below 17s and come in and retest 16s. Okay, what that does is it puts that S&P firmly above 6,000. We'll get to the S&P chart in a minute. In terms of the bonds, okay, they've done squat diddly do now for a period of 3 months. Okay, this is effectively a weekly chart. You can see bonds 2-year have gone nowhere for the last couple of months. Okay, and that's for good reason. There's nothing fundamentally driving rates at the moment. The Fed's on hold. They've told us they're on hold. we get a bad number, we get a less than 75,000, well, guess what? Look at these tops. Look at this sort of, sorry, that's for a very good number. Look at the lack of movement in the bonds. Should we get that number below 75,000, there's a lot of space for that 2-year to move back down towards that 350 level. And so, like I said, a number less than 75,000, a negative number, right? Don't be surprised to see the 2-year do a 30 basis point move on the course of the day. Why? Because it does open the door to a very aggressive rate cut as soon as the June meeting. Okay, of course, to the upside, we'll get a good number. We get a 250. Well, don't be surprised to see this 2-year scale above that 4%, because ultimately the market will then need to push back on this idea of a September cut. Okay, but the market will not remove the idea of all cuts altogether, because of course this is only one data point, and ultimately one data point does not make a trend. Okay, and then finally the S&P 500. It's an important chart for a number of reasons. We've been talking about this in terms of the strength of it. We've been talking about the dip buying. We've been talking about this gap down here and the dip buy there and the dip buy there and the dip buy everywhere. It's a market that just price action wise is not weak, not even close to weak. We can see that 20-day moving average is now caught up. Okay, so this little consolidation we've had now over the course of the May month, time has now allowed the market to normalize. We're no longer overbought in the near term, and so what that means is structurally S&P has got every right to go and smash through that 6,000 and move its way back up to record highs. Okay, what does it need today to get that? Well, it needs a number above 125,000. You get above 125,000, all concerns around the Liberation Day tariffs are off, and we will, of course, begin the process moving our way back up to that 62,000. Now, 6,200. Now, the key takeaway is that the degree of the beat today is ultimately what's going to drive the speed of the rally to record highs. Okay, you get a really good number, of course, we'll rally there a little bit quicker. You get just a good number, we'll of course rally there slower as the VIX just squashes its way back down towards 15. Okay. Conversely, don't forget, we are of course in the range. We know the bottom end of the range is 57.60. We know that that's a good 200 odd points away. Okay, so bad number, okay, less than 100,000, a 75,000, a negative number, you're going to be retesting 57.50 very quickly. Okay, so structurally, this market is good to the upside, it's good to the downside, and that's why today's very much a binary outcome for the S&P, because ultimately it is just going to be driven by whatever we get from non-farms. Okay. Now, with that in mind, of course, there's a lot to factor in there. I've obviously spoken quite a bit about what some of the opportunity scope is. So, again, it is non-farm payrolls. It is a day where there's a lot of potential opportunity. But it's also a day where ultimately the number could come absolutely in line. Okay, in which case, well, it's probably going to be more of the same, which is a very muted session. Okay, right now, don't forget, we've had a very quiet week, very, very low volumes all week. The market has been reluctant to do anything. So, sure. We could get a number in line, and that means you are going to have to sit on your hands and perhaps wait for the weekend to follow through into next week, and then we start to pick up on some of those more technical trades. Okay, with that in mind, if there are any questions about today's stream, do post them in the comments channel. As you will notice, I do like to comment on some of your comments, as well as, of course, for all the members, you can, of course, post in the Discord channel, and I'll get to those comments as well. Otherwise, it's Friday. Good luck out there. Manage the risk. Go make some money.